Hello, my dear students. We'll be continuing with issue of shares for consideration other than cash. Now, as we've already begun in the class with the discussion that a company raises its capital and forms the capital structure with issue of shares, different types of shares, right? Now, mainly we'll be discussing with the issue of equity shares and preference shares in this chapter. And as I've already rightly introduced in the class, that when a company issues shares, it wants to consolidate its capital structure. Of course, it is not possible to run a company without the resources which might be available to the owners of the company or stakeholders of the company only when they collect it from the public in general, and that is what leads to the concept of issue of shares. Now, as in one of the introductory pages of the chapter, we've learned that mainly issuance of shares are done by a company to raise total cash with which the company will be working, or it will continue with its operation. But what I'm going to discuss with you all today is that why will a company issue shares for consideration other than cash? What's its purpose, and what are the journal entries? How is the accounting treatment done? What is the impact on the balance sheet in such case, and what actually gives a reason or causes the fact that I will not use cash to pay a certain transaction, rather I'll issue shares to correspond that, right? On the other hand, like we are already continuing in the class with our discussions of authorized capital and issued capital, subscribed capital. Along with that, in the class we are also discussing what are the probable pairs of journal entries with every installment attached with the issuance of the shares. That will continue as it is, but this second segment, which is comparatively a smaller trimmed portion of the chapter that we need to know, that I'll be covering up today. So this is under broad category subhead 2 of your company accounts, as we are continuing in this chapter. Should be around page number 6.24. Now, companies may issue shares for consideration other than cash, say for purchase of assets, plant and machinery, purchase of business or services taken up by the promoters and underwriters to issue shares. It can be at par, at premium. At par means at the face value itself, or premium, that means some portion added along with the face value. Now, when you're issuing shares other than cash, the main reason is, suppose a company has purchased plant, machinery, land, building, they purchased business, taken over a business that actually costs a huge amount of money. So rather than actually paying that entire thing by cash, or in the form of check or cash, it's easier for the companies to assign certain names, assign certain shares in the names of the vendors, and that also gives a feeling of security to the vendor who's actually entering into a transaction, even if you are not being able to pay for that asset or business taken over fully as of now. Like you can see here, it's written issue of shares for purchase of assets or business, and mainly on the purchase of business, assets are debited while liabilities are credited. So the difference will be passed through the goodwill account. If there's a difference of deficiency in the asset side, that's the debit aspect, or if there's a difference in the credit side or the credit aspect, it will be transferred through capital reserve. If you remember, we've discussed this sort of an entry in the goodwill chapter already. That's chapter number 2, but there we studied it with the perspective of partnership accounts. Here the same entry, same journal aspect is considered, but with the concept of company accounts. Now, likewise, the same entry goes, if you can see on the next page, accounting entries on purchase of assets. Of course, it's a credit transaction, so it will be sundry assets account debit to vendor. Vendor is the supplier or the party or the company from which you're buying the asset. And on purchase of business, it will be you're taking over a business, so all its assets, liabilities are yours. So assets account debit to liabilities, and the difference would be adjusted against goodwill or capital reserve as it comes. The second set of journal entry is on issue of shares. If shares are issued to a vendor at par, then of course, what do you do when you issue share capital? If you would have issued for cash, it would have been, or shares it would have been shares account debit to capital, isn't it? But over here you are handing over the shares to the vendor, so it will be vendor account debit to share capital. And if the shares are issued to the vendor at premium, then the total amount for the purchase consideration, vendor account debit to share capital, the main at par value to securities premium reserve. They've given an example also over here, like purchase consideration of 9 lakhs 90, and it is supposed to be settled with 10 rupees share, each share of 10 rupees. Now of course shares are issued at par or at premium of 1 rupee. What would be the scenario? So when it is 9 lakh 90 and per share is valued at rupees 10, of course you got to issue 99,000 shares. How did you get that? Total capital divided by the at par value of the shares. Whereas for purchase consideration, when it is at premium, it will be 9 lakh 90 divided by 11. Where did you get 11? It is at premium of rupees 1. At par, the value is rupees 10. Along with premium of rupees 1, it would be rupees 11. So they've discussed a small example there. Issue of shares to promoters for services. Another important thing in chapter number 3 in commerce, I'm sure you must have studied about promoters of the business. If not, in class 11 when you studied about formation of the company, you must have studied about the functions of the promoters. Very, very important people. They are the first group of people, maybe directors, may not be so, who are in charge of setting up of the company, promoting of the company. So most of the times, because the company is not in a very good position to pay off the promoters in cash, against the functions that they are rendering or they render for the organization, company goes for an easy approach. They find the way out that, okay, fine, if promoters have been working for me, let me pay them. The company thinks, let me pay my promoters in the form of shares. The promoters will be in turn becoming shareholders, and company will also be relaxed in order to not be burdened by the payment of share. So of course, if you're handing over these shares to the promoters, so first and foremost you will be making a liability called as promoters against the goodwill or the incorporation cost that they have incurred. So it is incorporation cost or goodwill account debit to promoters, and you pay them in the form of share capital. You will be nullifying that entry by writing promoters account debit to share capital. Now issue of shares to the underwriting agent, the same thing you know already. Underwriting agent in class 11, I'm sure you must have studied under the concept of stock exchange. Once more, underwriting agents are those who actually take on the responsibility of selling your shares, company's shares into the market, but when they've already taken up the shares in their own name, they sell it not on behalf of the company, but under their own name, under their entire absolute ownership. So when you're paying off such underwriters, it would be, if you're paying them in some part of the money in the form of check, then underwriters account debit to bank, and the rest of it is, if it is capital, then to share capital. I would like to discuss two illustrations from your book in this case. This is illustration 11, where a company purchased a business SK Sahu and issued 15,000 fully paid up equity shares of rupees 100 each. If you can see the detailing, plant 3 lakh 50, land and building 6 lakh, stock in trade 4 lakh 50, and creditors, the only liability is 1 lakh. Of course, the first entry is all the assets will be debited against the credit items. So plant, land and building, stock in trade debit with their individual values to creditors, and you will find over here you've paid 15 lakh rupees to SK Sahu. How did we get that? 15,000 fully paid up equity shares of rupees 100 each. So 15,000 equity shares into rupees 100 is 15 lakhs, and the deficiency that you get in the debit aspect is 2 lakhs balancing figure, which will be set off against goodwill, and you pay SK Sahu, the person from whom you've taken up the company. You will be nullifying that person by debiting. So SK Sahu's account debit to equity share capital of 15 lakhs. And how did we get that? 15,000 equity shares fully paid up at the rate of rupees 100 each. So that was one. And then you could come to the next illustration. This is Suman Limited was registered with an authorized capital of 10 lakhs divided into 1 lakh equity share. So that's per share, per equity share is 10 rupees. Now over here they've only asked for the balance sheet. So if you see, they've given up the entire breakup in the balance sheet itself. Here they say that equity shares were issued to a vendor as fully paid up towards purchase consideration of machinery. 65,000 shares were issued for subscription payable, 2 rupees application, 2 rupees allotment, first call, second call and final call. 60,000 shares were applied for an allotted. The company had made calls up to first call and received the called up amount except a call of rupees 2 on 5,000 shares. Now what's happening? If you go into the detail of issued capital, of course out of the 85,000 issued, What happened? 10 rupees each. So out of those 85,000 equity shares, 20,000 were fully paid up at the time of the contract only. So you're not worried about that. But breakup was provided for 65,000 shares, of which regarding 60,000 equity shares, you've got the money, and 5,000 will feature in calls in area. So subscribed and fully paid up capital will show 20,000 equity shares of rupees 10 each. So that's 2 lakhs. And along with that, subscribed but not fully paid up, 60,000 called up to the first call. So second and final call were debarred. So only 6 rupees were called up. So 60,000 equity shares of rupees 10 each, but 6 rupees called up. So that raises a total money of 3,60,000 minus calls in area upon these shares. So 5,000 into 2, that's 10,000 rupees to be deducted, and in the amount column it will be 3,50,000. Total it is coming to 5,50,000 that has been already raised. Machinery 2 lakhs and cash equivalents 3,50,000, and you could be arranging that in the main part of the balance sheet where share capital is 5,50,000 and non-current and current assets also add up to 5,50,000. Sum which is similar to this is again written under, say, Hardcore Business Solutions Limited. There what they've done is, we've discussed 2 illustrations, so they've basically combined the data, just changed the figures and the name of the assets a bit. They've combined the data, style of data, in this illustration, where they are saying that assets and liabilities of a company has been taken over, and then they are asking you to show in the form of balance sheet. So if you see over here, the first, where promoters are also involved, right? So over here, in the first journal entry, it will be goodwill or incorporation account debit to share capital. Please write both with the slash. It's not an option for you. We are going to write both. And then the next entry is that basic entry where assets are taken over, liabilities are taken over. Again, there's a balancing figure of goodwill that appears in the debit side. And finally, Shumanto, from whom the vendor actually, he's been paid in the form of equity share capital along with premium. And by this time, we've already discussed, or we will be discussing the various details of premium value attached with share capital, which goes under the heading of securities premium reserve. Balance sheet along with side in that same format. Authorized and issued capital will be all the basic data that has been given. The calculation lies in the part of subscribed and fully paid up capital, where over here 52,500 equity shares were given and the rate of rupees 10 each, out of which 2,500 equity shares have been issued to a promoter. Rest 50,000 were paid as purchase consideration for the business, and 50,000 rupees of the securities premium that will feature under reserves and surplus. We conclude over here. We'll be continuing with various sums under issuance of shares, and if any problem further with at least this part, that is consideration other than cash, we will be taking up in the class, as in how you come up with the problems and the doubts. Thank you everyone.